Hello and welcome to Big Deal. Now remember that post-budget, two big things have happened in the market. Ahead of 1st April, remember when the changes made, the amendment made by the Finance Minister to Section 1038 of the IT Act as well as Section 56 have created two things. First, a huge amount of intra-promoter share transfers, and the second, a lot of corporates rushing into formation of trusts. What does it mean and what should corporates do at this point? We have two important experts joining us to put all that together and give the right perspective to corporate India. Please welcome Girish, Vanvari as well as Sanjay, Buch. Gentlemen, so good to have you on CNBC TV 18. Girish, first, 1038 has been amended. Now we have seen Reliance Industries, DB Corp, Balakrishna Industries all rushing into intra-promoter share transfers. More to come, and why?
I think absolutely a red herring. 1038 says bonus shares, right shares, restructuring shares, merger shares, demerger shares, even stock options if you have any, may not get an exemption, because normally these kind of transactions happen as primary or doesn't happen on the stock market. If they're sold in the future, technically then it should be taxable unless the exemption list comes out from the CVDT which they promised. So as of now, the way law stands today is all bonus shares, right shares and the things which I mentioned will be liable to capital gains tax if sold in the stock market after April 1, 2017. So people are rushing today to increase their cost basis.
So what is the difference? Sanjay, come in on that. So like Reliance Industries has done huge block trades. Of course, there's tax applicability on that as well. So STT versus capital gains tax, how does it really match up? What are they really saving?
They are saving long-term capital gains ultimately because most succession plannings and inheritance is structured because of non-tax incidents. So if the succession planning is done in a way where there is a minimum tax incidence on the ultimate beneficiary or the successor of the business or the assets, it makes sense for the corporates to redistribute the wealth or restructure the wealth for the heirs and successors by forming the trust or doing through the inheritance route.
So we'll go into formation of trust as well, but let me first figure this out. Pay a small bit of STT so that you get a larger LTCG benefits.
Correct. So I think the benefit is 0.1% of STT today versus a 20% or a 30% short term or a 10% long term in the future. But the call here to be taken is that the CVDT promised to come up with a circular wherein bonus, rights, OFS hopefully will be exempt. That circular has not come yet. The fear is if all cases will be covered or not. Let's say Max, Adani, the new shares which you've got in their restructuring, will they be entitled to a STT concession in the future? Because you haven't acquired that from the stock market.
Right.
So people are in a panic mode, they are rushing and increasing their cost basis so that in the future, if the clarification is not appropriate, still they have some window to have a cost base to set off.
Right. But private equity investors who have come via FDI, they stand to benefit as it is, and what is the implication there, and does it also have limitations based on the treaty that we have, India has, with those countries from which they belong?
Yeah, private equity investors are original investors and the cost of acquisition remains the same for them. So obviously they are not sought to be covered unless CVDT comes out with a clarification.
I will just add to what Sanjay said. Private equity investors are normally from Singapore, Mauritius.
Yes.
So the treaty benefits normally exempts the transaction, whether you're still on the stock market or not. So hopefully they will not be in trouble, and most of the treaty amendments have grandfathered the past investments, both actually.
Yes.
However, there's a problem. The problem is that GAR is going to come on April 1, 2017. And the question is that will the treaty override GAR or will GAR override the treaty? So there's a double protection in sort of stock market transactions of private equity investors that when they sell on the market, they can also get the STT concession. That will go away. So they are not equal, they may be a little worse off, but they are not as worse off as Indians who may really be hit by this if the CVDT circular is not clear.
Yeah, so CVDT circular, and we have been expecting that for now about a month. So if that doesn't come, who stands to lose? The private equity investors, unless they are protected under the law?
Everybody. So take a situation. If there is no circular on April 1, and then if you are selling these new Adani shares which you got in the first 10 days of April, Or you are selling these bonus shares which the PSUs have given on the stock market. What will you do? You haven't acquired them on the stock market, but you're selling it on the stock market. And there's no circular to grandfather or exempt those trades. So effectively, you have to pay taxes.
So last year, we saw so many IPOs, smaller ones, where most of the sponsors were really exiting through the IPO. If those sponsors were to come this year, then they would have really not made any returns. Their returns, a large part of their returns would have really been wiped out because of this.
Yes, because there's a tax cost associated with it. So I'm not worried about the new IPOs also. All the past players also who've done IPOs, and if they sell in the stock market, they don't have a benefit of purchasing on the stock market.
Yes.
So they will get impacted.
Yes.
And as I told you, don't forget stock options. Employee stock option plans in big IT companies, big pharma companies, they also will be in trouble.
So you want to elaborate on who are the losers in this particular case, Sanjay?
Yeah, the question is important from the perspective of the succession planning, as I've been saying earlier also. Those promoters who, through the web of unlisted, closely held private entities, not on the stock exchange, have been controlling directly, indirectly stakes in these companies since they were MAT exempt and not the full rate of tax was not payable on these entities. Those entities would definitely, as Girish says, are sort of in a rush to restructure their current holdings so that they comply with the requirement of the long-term capital gains tax not to be paid if the transaction is done prior to 31st March 2017.
So a large part of transactions coming into the market could also be towards succession planning of by the promoters?
So I would put it this way. I want to step back. There were two biggest fears for the budget. One was, will LTCG get abolished? And second was, will inheritance tax come in? Inheritance tax has not come in.
Yes.
But people are fearing that that may come in one day because it's there in all jurisdictions. Now, GAR is coming in April 1, 2017.
Yes.
So if you have to do any restructuring to get into a trust structure, so the question is, should you do it now or should you wait? And there's one more amendment which has come in this budget, which is not spoken too much about, but is very relevant, and that is amendment to section 56(2)(10). And the debate which has got stirred in the industry today is that with this amendment, would a contribution to the trust be taxable or not taxable?
Right.
So people are now figuring this amendment out. Now, I just want to elaborate on the trust concept. The way this works is that there is a settler, there is a trustee, there is a beneficiary. So if you form a trust, you settle your assets to a trust, trustees manage it, beneficiaries get it.
Yes.
If this amendment is right, that any contribution to a trust is taxable, then when you contribute, you have to pay tax. When the trust distributes, you have to pay tax. And the question is, how do you structure the relationships between a settler, a trustee, and a beneficiary?
So any sort of private transactions for these companies are getting taxable at both ends. That is the main crux of the amendments that have been made.
Or I would say there's a debate that would it be taxable or not.
Okay.
According to me, the better view is it should not be taxable because trust is nothing but the beneficiary.
Yes.
Contribution to the trust cannot lead to taxation, but that's the fear people have.
All right.
So we just have to treat this very carefully. And if this fear is right, then I just wonder whether formation of trust itself is right. Because
so are corporates rushing into formation of trust right now?
Yes.
And why? To safeguard themselves from higher taxation later?
For two reasons. To get out of this 56(2)(10) fear. And second is from GAR fear. That tomorrow if GAR comes in, then what happens? But then I want to go back to Sanjay. Sanjay, I don't think everybody can do it because contribution to trust also has a takeover code issue.
Exactly. So listed companies will have challenges to fulfill before 31st March because there are timelines attached to SEBI takeover code claiming that exemption unless you satisfy the conditions which are prescribed. As also in the case of Reliance, if you see the deal, the promoter holding has not undergone any change.
So that is the case with all of them. It's just intra-promoter share transfer.
So for listed corporates, it will be important to comply with the SEBI takeover code, but it has its own challenges.
But as long as the promoter shareholding in the company remain the same, whether you put it from one pocket to the other and then pay the applicable taxes, that does not come under any restriction, right?
Correct.
But which are the cases where it could be restricted is what I wanted to understand.
So under 56 sections 56(2) Roman 10, they have categorized exempted transaction, and there is no clarity on the transaction which could also come under the fold of 56. So 56 amendment has expanded basically the entities which could be covered and not be exempted from tax. And that is, as Girish said rightly, the government intended to cover, these are anti-avoidance measures, basically to plug the leakages of revenue and ensure that the tax exchequer gains more out of it. So 56 to 10 covers relatives, inheritance and public trusts.
Right.
It does not indirectly cover the private trust, which is the case which he was talking about. Private trusts are created by mostly the promoters to control the stakes in the downstream companies and operational companies to the beneficiaries.
Right.
So private trust is an issue, is a debate currently whether private trusts which are settled by the promoter companies, which are related entities, means the brothers, sisters or promoters, whether GAR can be applied to it to look through the transaction post 31st March 2017 to say that this was done to avoid tax and not to plan tax. So there is a debate which is aggressive tax planning and abuse and anti-avoidance measures, which are now the debate, because India is a signatory to G8 also, where they have given the commitment that all taxpayers needs to sort of give the fair share of their taxes, and we should have information exchange agreements with the countries to plug the leakages.